Lesson 12, Fibonacci numbers and convergences. Before we get started, I'd like to point out a couple things. At the back of the book, there's a great exercise for understanding the convergences. The second thing I'd like to point out is up in the top left-hand corner, I have a sign called Important Information. You'll see this sign appear throughout this lesson. Please reread and understand the contents that is on that page. That will help you become a better trader. Some of the information are traders' tips and helpful hints that can help you make money as well as help you avoid losing money. Also in the bottom center, you'll see a number. That is the number slide that we are presently on. Throughout this lesson, if you get lost, just cross-check the number in your workbook to the number slide that you're looking at. There are 16 lessons on trading the Forex to help you. These lessons focus in on technical analysis and are applicable in other markets. Successful traders will do what unsuccessful traders can't and won't do. You will find that successful traders are successful for a reason. Understanding convergences will play a big part in your success as you trade. The 21-day 3% rule is all about the human mind forgets 80% of the knowledge it acquires within 3 days, and over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. If you don't use it, you lose it. Play this lesson over and over again until you understand it, because by the end of this lesson, you will understand that the markets can only move up, down, or sideways. You will learn that there are natural laws and a numerical sequence that governs our universe. To really understand that, please play over and over again. Lesson 7, the price swing and Fibonacci numbers. You will learn to read a trading chart and be introduced to the technical side of Fibonacci trading and convergences. You will learn that the market bounces at convergences, and you will learn how to find a convergence and trade in the direction of the trend for profit. You will learn to create a trading plan based on trading convergences and learn how to financially protect yourself as support or resistance in every trade. Let's do a quick review of placing orders. Lesson 1, we're watching Japanese candlesticks that monitor the open, high, low, and close of the market. We are watching bid charts. There is a bid and an ask at all times in the market. There are traders trying to buy and traders trying to sell. Traders buy on the bid, traders buy on the ask and sell on the bid. These candlestick charts monitor the bid price. Up here, the current price is the bid price, 107.30. That is where the market is currently. It's at 107.30. That's the bid price. The ask would be 107.35. If we were to look at an ask chart, it would look exactly like it, only 3 to 10 pips higher than the bid chart. Once again, we buy on the ask and we sell on the bid. That is very important information. If you enter the market, you'll be buying on the ask. You'll need to place 2 sell orders, one for a protective loss stop, which will be on the bid, one for a protective or for a sell limit, which is also on the bid. Conversely, if you enter selling, you sell on the bid, which is this price, 107.30. Your 2 buy orders will be placed on the ask, which means the ask price will hit your buy stop order before the bid will. So please don't lose sight of that. I've explained this at the beginning of each lesson so that you clearly understand where and how stop orders work and limit orders work. The types of orders you're using are market orders, which is an order placed at the market. Whatever the bid and ask is, that becomes your order. A limit order is an order placed to enter or exit the market at the exact placed price or better with no slippage. Stop orders are an order placed to enter or exit the market at an exact price that turns into a market order when touched. Any order that's placed above the market or below the market is called an open working order. When you buy above the market, you tag that as a stop order. When you sell above the market, that will be a limit order. It'll be an open working unfilled limit order. When you buy below the market, you tag that as a limit order. When you sell below the market, you tag that as a stop order. They will be open working unfilled orders. Ordering rules: every buy should have 2 sells, one for profit, one for loss. For whatever reason you enter the market on a buy, you'll have a sell limit for profit and a protective stop loss order, sell stop, for potential loss. If you're shorting the market, you should have 2 buys. Every sell should have 2 buys. When you enter selling, you should have a protective stop loss order at the last high and a limit order, a buy limit exit for profit. OCO means whenever you enter the market, a buy with 2 sells or a sell with 2 buys. OCO means you attach the 2 orders, and whichever the market hits first, it will cancel the other order, so you don't have a open working order. Cancel replacing: please remember, only cancel replace to the new last low after the market has made a new high, enabling you to take advantage of the full move. The same will exist in chasing the market. In a bearish direction, only cancel and replace to the new last low after the market has made a new low. Bulls buy low first and sell high second. Bears sell high first and buy low second. Either way, bears who short the market buy low and sell high. They just do it opposite of a bull. Technical traders learn to read charts. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. Why? Because we're creatures of habit. Because a chart is a chart is a chart, technical analysis becomes applicable to all charts that you can pull up. Go and look at all the charts in your financial portfolio, and once you've been educated on how to read charts, you will start to control your financial future. Let's review support and resistance real quick for this. Remember, highs are 2 candles to the left, 2 candles to the right that are lower than either the body of the candle or the wick high, and not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently trading. Lows are 2 candles to the left and 2 candles to the right that are higher than either the body of the candle or the wick low. Not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Please don't underestimate the financial game, which is clearly discussed in Lesson 2. You want to train your eyes to just scan a chart and see all the levels of resistance and all the levels of support. All protective stop loss orders must be at the last low if buying and the last high if selling. Remember, if you buy, place your protective stop loss order at the last low, and do not trade without a protective stop loss. If you are selling and shorting the market, you will place your protective stop loss order at the last high, and do not trade without a protective stop loss order. If the stop order is too far away from the entry point and does not meet your equity management requirements, pass on the trade. Go find another trade. So let's review trends and trend lines real quick. Lesson 5, an uptrend is when the market is making higher highs and higher lows. That is an uptrend. You draw your trend lines across the lows. As you can see in this chart, draw your trend lines across the lows. There's three primary upward trend lines that we're monitoring. One is an inner, outer, and the long-term outer. Downtrends work the opposite. The market is making lower lows and lower highs. When you spot a downtrend, you draw your downtrend line across the highs, just as you see it in this chart, across all your highs or your levels of resistance. There are three primary downtrend lines that are forming. One is called an inner, an outer, and a long term. Lesson 5 really focuses in on teaching you how to draw your trend lines. Just a quick review on price swings and extensions with Fibonacci numbers. To really help you understand this lesson, you really need to review and understand Lesson 7, price swings and Fibonacci numbers. But this is the business in its entirety. You have a rally, a retracement, and then another rally in an uptrend, which is called the extension. Please study that, understand it. This is how the market works: rally, retracement, extension. It's only when the market takes out the previous high in an uptrend that it is working on the extension. In the Fibonacci numbers, believe it or not, the market is governed by natural laws, just like the world is governed by natural laws. We have the Fibonacci sequence, which is 2 plus 3 equal 5, 3 plus 5 equal 8, 5 plus 8 equal 13. This was discovered by Leonardo Fibonacci in the year approximately 900 AD. As he studied numbers, lesson 7 is quite fascinating to understand how he went about discovering all this. But we get involved in ratios, which is starting to divide numbers. If we divide 89 by 144, we come up with 618. And 144 by 233, we come up with 618, and so on and so forth. In all these divisions, we come up with some numbers, which are 382, 50, 618, 786, and extension numbers, which are 1.618 and 1.27. Fibonacci ratios are hidden potential levels of support in an uptrend, and they, if the market bounces at a 382, 50, 618 and takes out the previous high, it should go to the 1.618, just as you see it here. These are all the retracement values. These are your extensions. If the market bounces at any of these levels, U-turns, takes out the high, it should go to the extension. In an uptrend, if the market bounces at a 786, it is slowing down, and when it U-turns, it goes only to the 1.27 extension. Look at how the market rallied, retraced all the way to the 786, bounced, and only went to the 1.27 extensions. Downswings work exactly opposite, and in the same numerical sequence. In a downtrend, the market is swinging down, creating downswings and downswing extensions. Look at how here is the market. It is swinging down, retracing, and going to an extension. Fibonacci ratios are hidden potential levels of resistance in a downtrend. These become the Fibonacci numbers in a downtrend, which are the opposite of an uptrend. Contact us here at Market Traders if you do not understand how to spread your Fibonaccis on your data. Make sure that you have a data program that can give you all the Fibonacci numbers and their extensions. But in a downtrend, if the market bounces at a 382, 50, 618, U-turns, takes out the low, it should go to the 1.618 extension, just as you see it here. Anywhere here at the 382, 50, 618, if it bounces U-turns, it should go all the way down to the 1.618 extension. Look at how it went down, hit the 1.618 extension. Now it's bouncing back very aggressively. And if it retraces all the way back to the 786, it will only go to a 1.27 extension, just as you see it here. Here is the downswing. There's the 786 bounce. Anything inside the swing is sideways movement. This is where traders get confused sometimes and end up losing money because they're not keeping track of the original swing. The reason you want to trade in the direction of the trend at a 618 or 786 Fibonacci bounce is because if the trade does not work out and the market decides to reverse, your losses will be small. And if you properly listen to the market with your eyes and you look where the market has been, it will tell you where it's going to go. Look at how if you entered here at the 618, it did bounce, but then it formed that Gartley that we talked about in lesson 13, and came all the way back down to the 786, bounced off the 786, and then took its time to go to the 1.27 extension. The market has been slowing down. Lesson 12, Fibonacci numbers and convergences. I have found this lesson to be very, very necessary to the success of a trader. Understanding convergences creates a greater probability of a bounce and places your trade in a higher percentage of moving in your direction, because the term convergence means a location where there is more than one hidden educated reason for the market to bounce. Example, a trend line, a fib number, a completion of a beat, etc., an evening star, morning star, whatever the case may be. As a matter of fact, you would like to find a location where there is a compilation of several issues. Now, uptrend price swings. Remember, we start with the low and high, and that constitutes an uptrend price swing. Well, and uptrends are when a chart is establishing higher highs and higher lows. Well, those swings can make up bigger swings. In other words, 2 small swings can make up 1 large swing, or 3 small swings can make up 1 large swing. But the market moves in waves. Those waves are called price swings. Uptrend price swings start at a low and stop at a high. 2 small swings can create 1 large swing. Let's look at this chart. Let's look at all these little swings going up and down, create 1 big upswing. That's because there are swings inside of swings. Look at this chart. Look at how the market was swinging up, then swinging down, then swinging up, but it created 1 big upswing. Now, just like there's trends inside of trends, look at this uptrend, downtrend, uptrend, and an overall uptrend. See the trends? Market rallies, breaks the trend line, reacts, comes down, breaks the trend line, rallies. But be that as it may, we were in an uptrend, downtrend, uptrend, but we're in an overall uptrend. Now, in an uptrend, the market moves in a numerical ratio, just as I showed you in the Fibonacci's, bouncing from 618 going to 1.618, bouncing at 618 going to 1.618, just as you see it here. Swing 1, retracement, extension. Swing 2, retracement, extension. Swing 3, retracement, extension. Uptrend price swings, 2 small swings can equal 1 big large upswing. Now, once again, 2 small swings can create 1 large upswing, and 3 small swings can create 1 large upswing. Let's look deeper into the up price swing and Fibonacci ratios. Look at the white here. Look at how that's swing 1, swing 2, swing 3, and look at how it's retraced back. Let's pretend that this was just straight pure movement and created 1 big upswing. Look at how if I spread my Fibonacci's, I would be at a 382. That's the red. Let's say I started here at this low, and now I moved up to this high, always ending at the same high. When you're trying to figure out convergences, you will, in an uptrend price swing, you will start at different lows, but always stop at the same high. Look at how starting at this low, coming up to this high, this is the 5-0 of this swing. Now I start at this low, coming up to the same high. It is now the 618. Let's look at it on a chart. Maintaining the same high, I go back to the first low. I find out that's the 618. I then go back to the next low, spread my Fibonacci's. I find out that is the 5-0, right here, this low. I go back to the next low, maintaining the same high, and I see that that is the 382. So right here at one location, I have a 38250,618. That is called a Fibonacci convergence. Now, it works the exact same way in a downtrend. You can have two small downswings equal one larger downswing. The market moves in waves. Those waves are called price swings. Down price swings start at the high and stop at the low. Two small swings can create one larger swing. Let's look at this one. Starting at this high, ending at this low. Look at how that is one swing. But it is, if I have used two swings, that is all one swing created within two swings. Now let's look deeper into that down price swing and the Fibonacci ratios. Look at the white, how the white creates 1, 2, 3 swings. And if I start at the same low now, as I'm looking for convergences in the direction of the trend, I start at the same low, I go back to the first high, that is the light blue. Look at how if I start at that high and go to that low, that is the 618 of that downswing. If I back up and go to the previous high, that then becomes the 50, all at the same location of that swing. And if I back up and go to the previous high, maintaining the same low, that is then the 382 of that whole swing. Let's look at it here. Right here at this location, that is the 786 of that swing. That's the light blue. Using the same low, I back up to the previous high. That then is the 50. That's the green. Look at how it's the 50. And then let's look at how if I back up all the way to the previous high of the highest high on this chart to this same low, that becomes the 382. At that location, that's where the market bounced. Now I want to go through a trading exercise. Since I pointed this out to you, and since you've listened to lesson 7 in detail, which is about price swings and Fibonacci numbers, I want you to go and find Fibonacci ratios, because the best way to understand what you've learned is to write down what you think you know, then go back after you have been taught and look at what you thought you knew versus now what you know. Find convergences and Fibonacci numbers on this chart. This is a 4-hour chart. They work all the same on all the charts. Put your recorder on pause and find convergences. This is what you should have found. Look at how at this location, see this rally, retracement, rally. See how that's the 1.618 of this 618 bounce? Notice how that is also the 786 of this bounce. I focus in on lesson 13, trading Gartleys, because this is a Gartley. It is a Fibonacci move inside a Fibonacci move. But look at how at this location you have a 786 and a 1.618 all at the same location. Find convergences in this chart. Put your machine on pause. This is what you should come up with. Look at how you have a 786 of this swing with a 1.618 of that swing. Find convergences in this Euro 30-minute chart. This is what you should come up with. Look at how we have a 1.27 here. Look at how we have a 382 of that large swing and a 786 at this swing. All at the same location. And then tweezer bottoms appear, which lend itself to a great trading opportunity. No wonder the market is rallying. Find the convergences in this chart. Put your machine on pause. This is what you should come up with. Look at how at this location where the market bounced, it was the 1.27 of the red move. See that? Here's the downswing, the retracement all the way back to the 786, goes all the way down to the 1.27, and that 127 happens to be the green all the way down from the lowest low on the chart to the highest high. That's the 50. And it happens to be the 786 of this low to that high. Keeping in mind, we keep using the same high as we figure this out. So right at this location, we have a 786, 1.2750 convergence. Convergences are locations where the market is going to bounce. Using the same chart, look at here. Look at how this location was the 786 of the big swing, which is the blue, and the 1.618, which is the red, the 1.618 extension of this upswing. Look at this bounce using the same chart. Look at how it is the 50 of the big swing, the 786 of the smaller swing, and the 1.618 of a smaller downswing, which created a bounce. A morning star appears, and look at how the market rallied right at that convergence. Trading is all about understanding price movement against time. Look at when we add a trend line. Look at how as time is used up, the trend line rose. Look at how the market slowly dipped and hit the trend line and convergence all at the same time. Lesson 5 focuses in on trend lines. This lesson focuses in on convergences, which focuses in on price movement against time. And what is amazing is price and time usually move to match up to a point in time and location where everything naturally and numerically will line up and bounce. That is called a convergence. Let's look at this one. We drew the trend line. Look at how with time the market slowly rallied to where trend line and time come together at a 786 1.618 extension bounce. Now let's go through a trading exercise. Let's trade a convergence. Turn on your computer software, which monitors the success that you have or don't have. Convergences can create that bounce. Don't forget that. That becomes your belief system. We're out there looking for convergences. Because let's face the facts, every trader wants the market to move in their direction from entry. Look how education on how the market works in convergences can improve those percentages. Now the rules to trading a convergence are this. When you turn on your computer, find all your trend lines, your inner, outer, and long term. This will help you determine if you are in an uptrend, downtrend, or if the trend line has been broken, signifying a potential reversal, an end of a trend. Look for a big price swing in an up or down direction. Use your Fibonacci tool on your software and draw your Fibonacci lines and find the potential 618 or 786. Now here's your rules to trading a convergence. Continued. Find a small swing moving in the opposite direction. Use your Fibonacci tool on your software to draw your Fibonacci lines on the small swing and find the 1.27 or 1.618 extension that matches up with a 618 or 786 retracement of a bigger swing. Try to find any other convergences that may appear at that location, i.e. trend line, the finishing or termination of a harmonic beat. Look at the potential risk with your protective stop loss orders. If you can't afford to trade and incur a loss, then stay out and do not trade. Pull your trader's checklist out and create a trading plan. Now, anticipation is the key to successful trading. When the market is moving to the extension on the small swing, you need to anticipate its arrival, and you need to start setting up your trade. as it starts to move in that direction. Meaning, look at how I have an upswing here. I now have a retracement. It bounced. It created a U-turn. And now that it's taking out the previous low, as it continues to retrace, here is where I start preparing. The opposite will take place in a downswing. As the market bounces and goes up, here is where I'll start to prepare. Now let's look at here. I have a huge upswing here. The market was retracing. It created a tweezer bottom. It bounced. Now I will go with the downswing. This becomes my downswing. This then becomes my rally, retracement, bounce at this low. Here it becomes working on the extension. Look at how I'm starting to take out the previous high. It is at this time I start to prepare my trade. And this is what I start to prepare. If you can't visually see this, because you do have to become somewhat spatially intelligent as you work on charts, if you can't visually see this on your computer, print this out on your computer. This is not a game of seconds. This is a 2-hour chart, which means each one of these candles take 2 hours to form. Print out your chart. Now look at, if I draw the rally, retracement, and extension, and if I go all the way from that low to that high to that retracement, which looks like a 618, look at how the 1.618 will happen to line up with a 786. And right there is where I'll have a convergence. See, this is the downswing. This is the small upswing and extension inside the downswing. Look at how right there is the 1.618 extension, because it's bouncing at a 618. And because it bounced at a 618, when it takes out the high, where should it go? 1.618. Look at how that 1.618 is the 786 of this downswing. See that? Everybody, we're on slide 114. Now, put the two together, and this is what you have. You have what's called a convergence. You have a location where you are at a 786 of the downswing and a 1.618 of the upswing. This is also known as a Gartley, but more importantly, that is a convergence. So when you spot a convergence, you'll want to fill out your paperwork and pull out a trading form, pull out your trader's checklist, place your limit order to enter the market before the projected retracement bounce, and place your limit order to exit the market before the projected extension bounce. If you are going to be trading with limit orders, once again, you'll need to get in before it bounces, and you'll need to get out before it bounces, because many times it goes right up to the number quickly, bounces, and if you are right at the number, your order will not be filled. The reason you want to trade a 618 or 786 is because those are locations where the market bounces. If the market decides to reverse, your losses will be small. Be that as it may, this is a 786, 1.27 convergence bounce. We are anticipating the market to bounce at this 786 and go down to a 1.27 extension. So we'll short the market here with a protective stop loss order up at this last high. Now, if you listen to the market with your eyes and look where the market's been, it's going to tell you where it's going to go. Because it bounced at the 786, it should only go to the 1.27. Look at how here's the downswing right here and the Fibonacci numbers for the downswing. That's what these lines are right here. Look at, this is the 1.27 extension and the 1.618 extension. These are the upswing retracement numbers. This is the 618 retracement. It goes to the 1.618, which happens to be the 786 of the downswing. When the market bounces there, look at how it goes down to the 1.27 extension and bounces again. Believe it or not, the market forms another convergence. Look at how, using the same chart, this low to that high, that was the 786. You see it right there? That's the 786 of that upswing. It's also the 1.27 extension of this downswing. We profit took coming down here. Now it's time to reverse our position. Look at how the market bounced right here at this convergence. Once again, your trading software will monitor your P&L statement, but fill out all your paperwork on your trading form just in case there are any discrepancies, as well as to maintain a written track record of everything you're doing. Now let's trade a Fibonacci number trend line and convergence. Turn that software on again. Rules to trading that convergence are this. Find your trend lines, inner, outer, and long term. This will help you determine if you are in an uptrend, downtrend, or if a trend line has been broken, signifying the potential end of a trend. Look for a big price swing up or down. Use your Fibonacci tool on your software and draw your Fibonacci line and find the potential 618, 786 retracement. Find a small swing moving in the opposite direction. Use your Fibonacci tool on your software to draw your Fibonacci lines on the small swing and find the 1.27 or 1.618 extension that matches up with that 618 or 786 retracement of the big swing. Try to find any other convergences, i.e. trend lines or beats. Look at your potential risk. If the risk is too great, you may want to pass on the trade. Pull out your trader's checklist and trade that plan. Once again, convergences are locations where the market should bounce. And because we are taking the time to educate ourselves, we now place ourselves in a high percentage chance of having the market move in our direction from entry. Now you spot an uptrend, so you draw your inner and outer trend lines. Lesson 5 focuses in on that. You draw your Fibonacci numbers from the low to the high of the current upswing. This is the current upswing from the low to the high. You'll notice that you have a 382, 50, 618, 786, and we are eating up time. You will then pull back using the same high and draw your Fibonacci's from a lower low. On this swing, you see a 618 trend line convergence slowly working its way to have the two meet. Now remember, we have two small swings can equal one big large swing. Let's pull back, as I said before, and let's spread our Fibonacci's from the previous low and look at how here's the two swings making one large swing. As we spread our Fibonacci's, look at how the market is slowly, or can slowly, come to a 382 of the big swing and a 618 of the smaller swing. That is called a convergence in the direction of a trend. When you put the two together, this is what you have, a 382, 618 trend line convergence, which places this trade in a higher percentage rate of success because we are also trading in the direction of the trend. It is an uptrend. The market is making higher highs and higher lows. A 382, 618 Fibonacci convergence entry in the direction of a trend is what's called a high percentage payoff trade. For some reason, 618s and 382 convergences in the direction of the trend seem to pay off a high percentage of the time. That's a trader's tip. Once again, trading is all about being patient and letting the market do its natural thing. Look at how, as we will eat up time, the trend line will grow, and the market appears to be making a tweezer top. And if in this tweezer top, we could almost short this all the way down to the trend line. But we're not going to do that because we're staying focused on the 382-618 bounce. Our entry is to buy the 382-618 trend line bounce. Now, every trader should have a trader's mantra, which is I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management. I will never trade without a protective stop. I will not chase the market. I will be patient and wait. And I will wait until the market will meet the criteria of my trade, or I will not trade. Once again, this whole lesson is about convergences, and convergences are locations where the market should bounce, and if we are patient, it usually will pay off and be big money trades. Once again, I can't emphasize this enough. The reason you want to trade 786s and 618s is because if the market decides to reverse, your losses will be small. Fill out your paperwork. Keep your losses small, and the profits will take care of themselves. Let your profits run. Focus in on your potential losses. Keep those losses small. Now here we go. The market dips and retraces to the 618-382, just doing what it naturally does. It bounces. We wait and we enter at the 618 trend line. Now here the market hits the 618 and trend line, and look at how it bounced straight from there. The reason it bounced hard is because right here was a series of hidden convergences. Convergences, I could equate them to being, if this was a river flowing, it is like a cement barrier. And each Fibonacci number is like a cement block. The more blocks you have, the stronger the wall. The stronger the wall, the greater the bounce. A trend line is a cement block. A 618 is a cement block. A 382 is a cement block. The termination of a beat is a cement block. Convergences, every trader is trying to find as many cement blocks in one location as possible so that the market will move in their direction from entry. Now, once again, we must listen with our eyes, because as the market is constantly moving from where it's been, it will tell us where it's going. Now this market bounced at the 618, 382, Fibonacci number, and trend line. But as it rallied, it did not take out the high, but U-turned to the 786. It is now breaking a trend line, which means this thing could reverse or it could bounce here at the 786. Remember, here's the original swing. All this movement inside this swing is potential sideways movement. The market could bounce at the 786, rally and go to the extension. We bought the 618. Our plans were to sell it at the 1.618. Now that the market has U-turned to the 786, we now need to adjust our limit. And we need to back off and come back down to the 1.27 extension, not the 1.618 extension. Be that as it may, our stop is still at the last low. We are still in this order, or in this trade, unless we were using one of the strategies in lesson 16, which would have allowed us to already take some profit out of here. Lesson 16 really focuses in on several different trading strategies and their justifications. Well worth your investment of time to listen to that and understand it. Now that the market went to the 786, once again, let's adjust our limit order to get out to the 1.27 extension. look what happens with time. Because the market came all the way back to the 786, we now need to adjust our trend line. Because it came back to the 786, the market is slowing down. Look at how much time it took up just to go to the 1.27 extension. This is a 2-hour chart. Your software monitors your P&L, but figure out your P&L on your trading chart anyway. Print out the chart of your trade so that you can go back and look. Once again, here's the rules to trading a convergence. Read them, understand them, memorize them. Let's all agree, you must have an edge when you trade. You must educate yourself so you know where to get in and understand the why behind it. You must educate yourself and know where to get out and understand the why behind it. Let's all agree that the market moves in a natural numerical sequence, just like our world is governed by natural laws. Entering the market at 618 and 786, trendline convergences, extensions, can create a greater potential for profitability. Create a trading plan and trade that plan. Did this lesson teach you that the markets are governed by natural laws? Did this lesson teach you that the markets work in a numerical sequence? Did this lesson teach you how to read a price swing and its extension, and how to find a convergence, and how to trade the convergence bounce? Did this lesson teach you how to create a convergence trading plan and trade that plan, and where to place your protective stop loss orders, and how to financially protect yourself in every trade? If this lesson did not achieve these things, go back and replay it. Traders are looking for convergences. Traders are looking for cement blocks where the market will bounce so that they can place an order there, so as the market hits that bounce, it takes them in and the market moves in their direction from the beginning. Because of this reality that 90% fail and 10% succeed, you owe it to yourself to do what successful traders do. They take the time to study, educate themselves, practice, see how the market works. There is a lot of money to be made here. There is also a lot of money to be lost here. Learning to trade is not about luck. It's an art. It's a skill. Focus in on how you can become one of the successful traders. Because if you are just trying to get lucky, it's only going to be a matter of time that you become unlucky. And if you become unlucky, then you don't have the education on how to earn that money back. The second way to make money in the market is to be mentored by somebody who knows what they're doing. We here at Market Traders, we are an educational company. ForexTips.com is an ongoing supportive company that continues to help traders find trades, enter trades, justifying why those trades work out. Being coached by a mentor is like buying a map to a gold mine. You learn where to get in and why, and you learn where to get out and why. You learn how to extract that gold properly. Because let's face the facts, all of us as traders, we have to pick a number, and we want to find comfort in that number. And we want the market to move in our direction from entry. Education on how the market works, educating yourself on how to find a convergence, improves those percentages. These 16 lessons on trading the Forex can help you tremendously. Take this education and apply it to the other financial products you trade, your stocks, your securities, any equities, options, commodities. They all come with a trading exercise that can help you hone in on your success. They all come with a trader's mantra. Success comes from discipline. Stay disciplined. And remember, if the chart is not clear and doesn't visually make sense, because this does take some sort of spatial intelligence. It's like reading an x-ray. When in doubt, stay out. It's not that difficult to learn, but please replay this lesson over and over again so that as you trade, you maintain 85 to 95% recall and you're not left only retaining 3% of your original acquired information that you've learned to trade on. On behalf of everybody here at Market Traders Institute, forextips.com, and on behalf of your hard-earned money that you are placing in the market to try to make more money, we'd like to thank you for investing in yourself and purchasing this lesson.